Open. CoreWeave just crossed 1 gigawatt of operational data center capacity. To put that number in context, 1 gigawatt is roughly what Equinix, a company that has been building data centers for 25 years and operates across 70 metros globally, took nearly 2 decades to approach in its early growth phase. CoreWeave did this in approximately 4 years of serious infrastructure deployment. The Data Center Dynamics report that broke this also confirmed something more consequential than the capacity number itself. CoreWeave is pushing further into self-builds, meaning they are acquiring land, contracting power, and developing their own facilities rather than leasing stabilized shells from third-party operators. That is the institutional red most people missed in the coverage. Because the moment a hyperscaler-class tenant becomes a hyperscaler-class developer, the entire demand signal that independent data center operators have used to underwrite speculative builds in primary markets starts to distort. The long-term lease from a cloud tenant, the instrument that has backstopped colocation and wholesale data center valuations for years, is quietly being renegotiated on structural terms, not just economic ones. That has direct implications for where capital should be positioned right now. The data layer. Let me put some numbers on the table. According to JLL's 2024 Global Data Center Outlook, primary markets, Northern Virginia, Dallas, Chicago, Phoenix, Silicon Valley, Atlanta, absorbed roughly 5,200 megawatts of new capacity in 2023 alone. That is a record. The prior record was approximately 3,300 megawatts in 2022. The pipeline in those same 6 markets currently sits at over 6,000 megawatts under construction, per CBRE's H1 2024 data center report. The vacancy rate in Northern Virginia, still the largest data center market in the world, has compressed to below 2% on powered shell product. Below 2%. That number alone explains why CoreWeave is self-building. There is no stabilized product to lease at scale. The traditional colocation and wholesale operators, Equinix, Digital Realty, Iron Mountain Data Centers, QTs, are either fully leased, pre-leased before delivery, or quoting rents that have moved 30 to 40% in 18 months. On the transaction side, Green Street's data center coverage through mid-2024 shows cap rate compression on stabilized and leased data center assets in primary markets in the range of 4.5 to 5.5% for investment-grade tenancy. That is not a yield story. That is a bond proxy for institutional capital that has already made the macro bet on AI compute demand. The development spread, stabilized yield on cost minus going-in cap rate, has actually widened in primary markets not because returns improved, but because land and power costs have escalated faster than rents in some submarkets. Greenfield development in Ashburn, Virginia, or the West Dallas corridor is now quoting power infrastructure costs north of $8 to $10 million per megawatt all-in, depending on utility interconnection complexity. That cost structure is only viable at scale, which is exactly why CoreWeave, Microsoft, and Google are the ones building there. The mid-market developer with a 20 to 40 megawatt site does not have the balance sheet to compete for those power positions. Real Capital Analytics transaction data from 2023 through early 2024 shows that the majority of large-format data center land sales in primary markets were completed by 4 categories of buyer: hyperscalers directly, REITs, large private equity-backed platforms like Aligned, Vantage, or Stack Infrastructure, and sovereign wealth-adjacent capital. Independent developers and family-capitalized operators were largely absent from that buyer pool in primary markets, not because of lack of interest, but because the land bases and utility timelines have made the return math unworkable at sub-$100 million check sizes. The mechanism. So why is the self-build shift happening now? Specifically, 3 converging pressures. First, colocation and wholesale lease pricing has moved fast enough that for a company deploying GPU clusters at CoreWeave's density, H100S and H200S at 100 kilowatts per rack and above, leasing finished space has become the more expensive path over a 5-year horizon versus owning the shell. The power purchase economics, the ability to control cooling infrastructure for high-density AI workloads, and the depreciation treatment on owned assets all favor the build-to-own model once you cross a certain scale threshold. CoreWeave crossed that threshold. Second, power availability in primary markets is now the binding constraint, not capital. PJM's interconnection queue, which covers the Mid-Atlantic and Midwest grid, had over 2,600 projects totaling more than 1,100 gigawatts in its backlog as of late 2023. The average wait time for new interconnection agreements has extended to 5 to 7 years in congested zones. When you are CoreWeave and you need 200 megawatts online in 18 months, you cannot wait in a public utility queue. You acquire sites where power is already contracted or shovel-ready. You hire the utility relations team. You work around queue constraints. That is not a capability available to a developer raising a $50 million equity check on a speculative basis. Third, the hyperscalers have learned from the 2021 to 2022 supply crunch that relying on third-party developers for capacity creates the timing and control problem. Microsoft's CapEx guidance for fiscal year 2025 included over $80 billion allocated to AI infrastructure. That figure came directly from their earnings calls and press releases. At that capital deployment rate, you cannot be dependent on a third-party developer's construction schedule, their lender's draw process, or their leasing team's negotiation timeline. You vertically integrate. CoreWeave is doing exactly that, where mid-market capital fits. Here is where I think the mispricing is. When the hyperscalers self-build in primary markets, they vacuum up the power and land in those markets, which means independent developers in Ashburn, Phoenix, and Dallas are competing directly with Microsoft and CoreWeave for the same megawatts. That is a competition they lose on cost of capital every time. But what those same hyperscalers are not doing, at least not yet, is building out secondary and tertiary power markets at scale. Columbus, Ohio, Boise, Reno, Chattanooga, Kansas City, Huntsville. These markets have available utility capacity on existing transmission infrastructure, lower land basis, and in several cases, incentive structures from economic development agencies that meaningfully affect the yield on cost calculation. CBRE's 2024 Emerging Market Data Center report specifically flagged Columbus and Reno as having available utility capacity that primary markets exhausted in 2021 and 2022. Columbus in particular has AEP infrastructure capable of delivering large block power with interconnection timelines in the 18 to 24-month range rather than 5 to 7 years. That is a structural advantage for a developer who controls a site today. The deal structure I am focused on in this segment is what I would call a site-controlled development carry. A developer or operator who has closed on land and has an executed utility capacity reservation, ideally a signed interconnection agreement or a letter of intent with a co-op or municipal utility, but has not yet sourced construction debt or equity. That asset, pre-construction, has a very different risk profile than a speculative land position without power. The power reservation is the moat. In secondary markets, that combination, titled land plus reserved power capacity in the 20 to 60 megawatt range, is the entry point I want to be at, either through preferred equity at the development entity level or through a first lien construction facility structured to convert on stabilization. Lease structure matters here too. The wholesale lease comps I am using as underwriting benchmarks are in the $90 to $130 per kilowatt per month range for turnkey capacity in secondary markets, depending on power cost pass-through structure. That compares to $150 to $200 plus in Ashburn and the Chicago market. The spread is sufficient to generate a 12 to 15% yield on cost in secondary markets at conservative assumptions, versus 8 to 11% in primary markets where land and power costs have already repriced. Net-net, the risk-adjusted development spread is wider where CoreWeave is not. Counterpositions and risks. The bear case on secondary markets is real and I want to name it precisely. Tenant demand in secondary markets is not the same as primary markets. The reason Northern Virginia commands sub 2% vacancy is because major cloud platforms require proximity to internet exchange points, fiber interconnection hubs, and carrier-neutral colocation ecosystems. Columbus does not have the same fiber density as Ashburn. Reno does not have the same carrier options as Silicon Valley. A 40-megawatt build in a secondary market that cannot attract an anchor tenant in the first 18 months post-delivery is a construction loan problem, and construction lenders on data center product have gotten more conservative on speculative secondary market development over the past 12 months. I have seen term sheets pull back on loan-to-cost ratios from 65% to 55% on sub-investment grade or untenanted speculative builds. Additionally, the AI compute wave that is driving the current demand cycle is concentrated in a relatively small number of well-capitalized tenants: CoreWeave, Lambda Labs, Crusoe Energy, and a handful of others. If the GPU utilization economics compress, and there is a scenario where inference workloads require less raw compute density than training workloads as model efficiency improves, some of that demand signal softens. I am not predicting that, but I am underwriting to it. which means I want assets where the power infrastructure itself retains optionality for industrial or advanced manufacturing use if data center demand underperforms. The other risk worth naming, utility relationships, are relationship dependent and jurisdiction specific in ways that are hard to diligence from the outside. A power reservation letter from a municipal utility in a secondary market is not the same as a signed interconnection agreement with a regulated IOU. The former can be rescinded or delayed. The latter has legal enforceability. I underwrite those two very differently. The position I'm taking. Right now I am actively evaluating two types of data infrastructure positions. The first is direct participation in site-controlled development plays in the 20 to 50 megawatt range in secondary markets, specifically operators who have executed utility capacity reservations and have a pre-identified tenant pipeline. Even if no lease is signed, I want to see the power reservation documented, the land titled clean, and a sponsor who has previously delivered a data center at scale, not a real estate developer pivoting into data centers because the cap rates look attractive. The technical operational expertise on the sponsor side is non-negotiable. The second position type is short-term asset-backed lending against existing stabilized or near stabilized data center assets in secondary markets, where the operator needs bridge capital to refinance construction debt before permanent financing is available. The loan-to-value on stabilized product with executed leases in secondary markets is supportable in the 55 to 65% range with current rents, and the yield on short-term bridge facilities in this segment is pricing at SOFR plus 450 to 550 in the current environment. That is not equity risk, and it lets me stay close to deal flow while maintaining optionality to convert into the development equity layer on subsequent projects with sponsors who perform. I am not chasing CoreWeave's primary market footprint. I am following the displacement that their primary market absorption creates. Close. CoreWeave crossing 1 gigawatt with a self-build strategy is not just a headline, it is a structural signal that reshuffles where independent data center capital can generate alpha. Primary markets are hyperscaler-as-tenant now. The development spread is thinnest where the brand names are loudest. The position is in secondary markets with site control and verified power capacity, structured at a preferred equity or construction debt layer, with sponsors who have delivered. That is the specific window, and it is compressing as the secondary market power maps become more widely known. If you are a developer with a side and a utility reservation, or a broker with a pre-vetted secondary market data center position, or a co-investor evaluating the segment, DM me at @DeBrody Official. I handle deal flow inquiries directly.